Welcome back to Vantage. As I'm filming this, NVIDIA's just reported just another blowout quarter, and we've had all the back and forth of Sam Altman leaving OpenAI, coming back, etc. We're going to focus on the tech sector and a particular focus on AI and what that's going to bring for us. Let's go and take a look. Welcome back to Vantage. We're focusing on the technology sector today. Delighted to have Alastair Unwin with us. Alastair, could you explain to people your role and the trust you're at?
Sure, thank you, Neil, and thank you very much for having me. So I am the Deputy Manager of the Polar Capital Technology Trust, which is about a $3 billion trust, investment trust quoted on the London Stock Exchange, now a FTSE 250 company, actually. And the trust is a broad church tech product. So the aim is to provide a diversified portfolio of tech companies across a few core themes, typically with about 90 to 120 stocks.
And if I reflect back to the start of 2023, the technology sector is actually surprised in terms of its performance through 2023. What's driven the outperformance, if you could help unpick that? And of course, within that, you're going to see relative winners and losers within the subsectors. So I'd love to understand, what's been doing particularly well, and on a relative basis, what has been underperforming.
You're quite right, it's been an outstanding year for tech so far, but I think it is worth remembering where we started. And coming into the year, things were quite bad. 2022 was a very, very tough year for tech. We had the Fed give 450 bips of rate rises. We had inflation averaging 8% that year. And really we saw the multiples for long duration growth tech, which is where we focus in the trust, cut by about 2/3. You saw Tesla down 2/3. You saw ARC down 2/3. Some of those areas really, really crimped on the multiple. On top of that, we also saw some of the hangovers from COVID still playing out as some of those trades unwound. So there were sort of reopening cross currents as people went out and didn't spend as much on PCs and mobile phones and those kind of things. So 2022 was a really tough year. I remember speaking to an internet analyst from one of the big sell-side shops in December 22, and he was almost on the verge of retiring because it was such a rubbish year. You'd had this great COVID blow-off, and it was, the prospects for tech looked okay. What's changed this year is actually the economy was strong. Growth came in better, inflation started trending the right way with a few bumps along the road, but things on the macro side did get better. The labour market remained very strong, and inflation was under control. So the immaculate disinflation that the Fed was searching for did start to materialise. What that meant for tech initially was a sort of flight to safety trade, actually. You saw the very large cap companies, the mega cap tech companies, do very well during the regional banking crisis in the US because these companies have lots of cash. They are very, very solidly positioned. They have no concerns about debt or really rate exposure. And we'd already had the derating of the long duration tech. But then the second thing, and probably the more important driver this year from our perspective, was the emergence of this profound new technology in the form of AI. And really the story of this year has been the rapid development, evolution and proliferation of AI across the tech space. And that's led to a couple of things. One has been the ongoing dominance of the largest technology companies. To give you a sense of that, large cap tech is up 60 year to date in dollar terms. Small cap is up 15. Yeah. And over the last 5 years, we're now at more than 110 point difference between those two. I mean, it's really, really extraordinary, which I'm sure we can talk about later, creates a headwind for us as active managers where we're kind of structurally underweight some of those big companies. Yeah. But it's certainly been a market led by them. The other thing that's worth remarking on, this is true of all tech companies, is if you remember in the second half of 22, we had a lot of layoffs. People were tracking layoffs week by week on how many tech companies were laying off tens of thousands, if not hundreds of thousands of people. That this year transformed into margin improvement, which was, I suppose, one of the reasons for it. And there had long been this idea that the tech sector wasn't profitable, or tech companies don't make money, and this kind of idea. And this year really put paid to that, because it turned out that tech companies, as we've long believed, have the ability to print whatever margin they like within reason. It's just the question of how fast they're investing. And that's been shown up. If you look at the average or the median software as a service company this year, they're printing a 13 or 14% free cash flow margin, and it was 6 a year ago. So it's very, very quick. That's obviously helpful when the macro is a bit better, that the top line hasn't fallen apart. But overall, it's been a combination of better macro, better margins, and the emergence of AI that's really allowed tech to lead, or large cap tech, I should say, to lead this year. We'll come into a year that we still had the roll-off of the sort of overbuying of PCs and mobile phones during COVID, and those remain weak. They've actually, sort of at the moment, this quarter have started to bottom, or the last few weeks started to bottom. So those are looking a little bit more interesting into next year, potentially. It's interesting you mentioned NVIDIA, because ChatGPT, which really heralded the launch of this new AI era as we see it, was last November. But from the market perspective, the AI trade really gathered momentum with NVIDIA's April quarter. And the reason for that was it beat by a lot. But the more extraordinary thing was that people were expecting, I think, 7 billion or so for the July quarter guide, and they guided to 11 and then delivered 13. And it's just extraordinary, the biggest beat semis has ever seen. And when you get these moments, it's something we've paid a lot of attention to. There was a similar one that Facebook had 10 years ago or so, when they moved to mobile, and they just suddenly showed that the economics of advertising in the newsfeed worked, and it just changed everything. And that inflection point tells you we're in a new era. And the NVIDIA print did that. So while there was some cyclical concerns around semis, there's still some in industrial and auto, which probably have still got a little bit further to go. Hopefully it'll rebound next year. What they said is we're moving to a new computing era, a new computing architecture, with NVIDIA at the core of that. But within that, there is a whole supply chain of companies who supply into NVIDIA. You need different, there are different requirements around packaging and the type of memory you need, the power source, cooling, all these different things that are in an AI stack that are different to a traditional computing stack. And actually we've seen some traditional computing spending around PCs and non-AI servers and be crowded out by the rush to AI, because this is such an imperative both for the hyperscalers and increasingly for companies adopting it.
Well, as we approach the end of the year, would love to think, we're in an macro environment where it's a little bit more benign than perhaps where we were 12 months ago. Love to hear about how you're thinking about positioning the portfolio for 2024 in light of the economic and rate cycle and the key themes that you're looking to express.
Well, assuming no severe recession, the Feds, to their credit, and central bankers generally, have done a pretty good job actually of getting inflation under control without unemployment really moving, and in some cases staying below pre-COVID levels. We don't think that will necessarily stay around these levels, but assuming that there is not a huge spike in unemployment or a big crash of some other nature, we think that a sort of moderating but low growth world tends to be a pretty good environment for growth tech, because growth is scarce. So we feel quite good about that. There's some signs that enterprise IT spending might recover next year, again led by the need to move to AI. If you think of the last 10 or 15 years as the digital transformation of the enterprise and of governments and to some degree of life, the next phase, we are very high conviction, will be moving to the AI enterprise and the AI supported life and kind of society even dealing with the implications of this amazing new technology. So for us, we're positioning the portfolio really to take advantage of AI, and that has been the big change we've made over the past, I guess, probably 9 months. Okay. And the reason for that is we think that this is the next big thing, actually. We think this could be as profound as the internet and the mobile phone, maybe even more profound than both of them put together. And so we reckon, at least in our estimation, that maybe 75% of the trust's holdings or of the trust's assets are in companies that are either enablers or beneficiaries of AI, which reflects, I guess, our confidence in it. And the bar for us to hold companies that are not beneficiaries or enablers of AI is quite high. And you've seen us disinvest from areas like fintech, like clean tech to some degree, because those areas partly are sensitive to rates, and we've, thank goodness we did disinvest, because it's been pretty rough sailing in both of those areas. but also that they're not that interesting from an AI perspective at the moment relative to, say, the semiconductor AI chain, relative to large software companies who are infusing their products with AI and are going to be able to charge more for them. We just think that the AI is the dominant theme of the portfolio next year.
We touched on it. Given the weighting in large cap technology names, would love to understand the philosophy of the trust in terms of the temptation to run your winners and also the concentration risk that sort of then creates. How do you balance out, the running of the winners against not being overly exposed to any one name?
It's a very good question, and it's something we discuss with the trust board at virtually every board meeting, because it is really important. They are laser focused on it, as we are, and it comes up in most client meetings. And there is an inherent tension between the absolute risk of a position size. So we have 10 or 11% in Microsoft if you include call options, which is a very large absolute position, which brings obviously Microsoft-based risk, and some of the things happening with OpenAI this week suggest that there are risks to the Microsoft story, however fantastic we think it is. Yeah. But we're still underweight our benchmark, so we have relative risk versus our benchmark in those stocks. What we've said in our annual reports and to clients and in discussion with the board is that we're unlikely to go much more than 10% in any of those names, because it seems to us a difficult thing to justify that you are reducing risk by getting ever more concentrated. And at some point, the absolute risk starts to eclipse the relative risk. And that's how we've thought about it. That said, these are phenomenal companies, and we've owned more of them than just about anyone else on a relative basis, because we have believed that they're natural monopolies. They're exposed to some of the most phenomenal trends that we've seen, probably some of the most profound trends available today for investors. They have, in general, sometimes slightly mercurial, but certainly very, very capable management teams. They're highly profitable. They have very strong balance sheets in general. There's a lot to like there. And even valuations, while they come up this year, relative to growth, don't look that stretched. So if we take the Magnificent Seven as an example, they're 29% of the S&P, but they're going to be about 20% of its earnings. So it's not super cheap, but it's hard to say there is definitely a bubble here, particularly when, this is I guess the tricky bit from our perspective, because we're so bullish on AI. The largest companies look well positioned for AI, is the truth.
You're a UK-based tech investor, and the reason I'm asking this question is that you can't escape the headlines of the de-equitization of the UK market, and in particular the smaller cap names struggling, and this is a generally sort of pervasive theme. Given the underperformance of small cap tech relative to large cap, and it's a theme which is more present in the market more generally, would love to hear what advice you would give to small cap technology CEO who's either gone public or is considering going public.
We don't tend to be in the business of giving advice to CEOs. We're not activist investors. We're very supportive shareholders, but we don't tend to be activists. What I would say about the public-private difference, a friend of mine is a public market CEO in the UK, and she said the big difference, which you don't expect, is that when you're a private company, more or less everyone you interact with is supportive of your goal. So you go around and raise money, and the people who invest back you, and they back you for 5 or 10 years. We don't do privates at all in the trust. We don't think it's the right vehicle for that. We think venture capital and private equity are better suited to that. The difference in the public market when you're a CEO is most people you interact with won't own your stock if you're a small company. A number of them will be short and will actively want your stock to go down, and might write short reports or unhelpful things about you. And so you have to be used to a slightly higher level of friction, shall we say, which I think is something people should bear in mind. But we'd love to see more growth technology company to come public in the UK. We'd love to have more in the UK.
We've picked it up before, but I mean, AI is a pervasive theme. Could you give us a slightly deeper dive into the opportunity you see? Is this just a tech opportunity or much more general? How you see effectively, balancing risk reward as you go through what inevitably is going to be, a hype cycle, and also, there are going to be bumps in the road. If you listen to commentators like Richard Windsor, a slight concern about the rate of adoption at this stage in the cycle. So, you are going to see some bumps out in terms of adoption.
It's a great question. It is the most important question that we think exists in the market today, not just actually for tech investors. So if we go back, you're quite right in saying, well, this has come to the fore with the emergence of ChatGPT and things that consumers we can interact with and touch and are genuinely different from what we've had before. The AI space and AI as a activity or as a research area has been around since the 50s. And we've had a series of AI winters as basically different approaches didn't work, often because they were underpowered. You were basically underclubbed for the kind of analysis and the kind of work that you had to do. So we saw some improvements in narrow fields. We saw IBM's computer beat Garry Kasparov at chess in the 90s. We then saw it 10 years later, Watson won Jeopardy. And then we saw from about the mid-2010s or late 2010s a kind of increase in the pace, and we've written about this in our strategy pieces and annual reports, where you saw Google beating the AlphaGo champion, you then saw superhuman performance at chess, at poker, you started to see text being generated, started to see images being generated, some of these early things. And what had happened was in 2017, Google released something, or released a paper actually, releasing details of something called the transformer model. And effectively, I won't get into the details of why these were such a major inflection point. But what they allowed was that up to that point, the amount of compute that you could put through a model in order to train this on a data set increased by about 8 times every 2 years, which in normal life is very, very fast. Transformer models came along, and through a variety of different techniques and the ability to process data in parallel as opposed to serially, they were able to put 275 times as much compute through every 2 years. So you just saw this massive inflection in the size and complexity of the models. That meant that we could train models on data sets that were enormous. So from 2020 or so, you can train the model on the whole internet. Very, very different scale what could be done before. You can have billions and now even trillions of parameters, which is effectively variables in the model. What that brought was these emergent capabilities, the ability to generate text, the ability to retain context, which is kind of built into that self-attention mechanism. So you saw this inflection in performance. That has now manifested in these amazing new technologies. And the question for us is, what's the right way to approach that? Initially, we're currently, and you see this in the NVIDIA quarter I referenced, there is an infrastructure build out and a new computing stack that sits beneath that. And we've got a lot of holdings there, particularly further down the supply chain, particularly in some markets where we haven't had much in the past. And we think this is one of the spaces where there are really good small cap ideas in Taiwan, in Japan, companies often that have been, I mean, to be honest, we haven't owned or really looked at that much for 15 years, suddenly look more interesting in this AI stack. So we think that's going to be a really interesting opportunity. To the bumps on the road question, there will unquestionably be bumps. There always are around a new technology. I think the difference here is that this technology is so profound it will be able to address at the moment something like a quarter of all jobs. At least a part of a quarter of all jobs. And that, if you sort of gross it up for the salaries, is about a $2 trillion opportunity. Yeah. In 3 or 4 years' time, there will be these technologies will be able to address maybe half of jobs, and that's a $4-point-something trillion opportunity. So vast, vast markets to go after. Really the knowledge worker wage bill, if you like, is the opportunity here. And to the point about speed and how vast is the monetization, because if all the cloud companies are spending this much on NVIDIA GPUs and power and everything else to try and get this technology to scale and get a lead, who is ultimately paying for this? Well, we've seen Microsoft launch the Copilot product earlier this month. I mean, we are incredibly early into it. I'm not sure how much monetization people would expect. So ChatGPT came out a year ago, and Microsoft Copilot only went GA, and you have to buy 300 licenses. Earlier this month, so I think we're quite early. We think that can be a $10 billion revenue stream for Microsoft within a couple of years if you work through the numbers. So that's real money. You've seen Adobe with the Firefly product get that into lots of people's hands. That's a big opportunity. So there are people monetizing it, but again, these are probably the earliest stages. The other point is, well, won't this take a long time to diffuse to everyone? Sure, this was interesting, but look how long it took the internet to make a difference. It all happened in the 90s, but it was another 15 years or 10 years before you got paid on it. That's true, but what we'd point out is that the speed of diffusion and the speed of adoption of technologies has been trending down over time. So it took the PC 20 years to get to 50% of workplaces. It took the internet about 12, took the smartphone about 6. You can see where this is going. Yeah. And the barriers to adoption for these amazing tools are really very low. If you have a smartphone and an internet connection, you have ChatGPT or Claude or Bard or access to any of these tools for free. And there are 6-point-something billion people with smartphones around the world. So we don't know, candidly, where the innovation in terms of use case and application will come from. It could be from a school in Indonesia or a university in Bogota. It doesn't really matter. It's just that this technology will be in everyone's hands very quickly. It's profoundly more powerful and improving at a rate that we frankly didn't expect, as excited as we've been about this technology. And you've seen that in things like ChatGPT, or based on GPT 3.5, could pass some professional exams. Based on GPT-4, it can pass nearly all of them. And that's within 6 months. I mean, it's quite extraordinary. And that when you see that rate of change, that power of technology and that potential for disruption, we think you have to stay liquid because things move very, very fast. You want to be in the infrastructure build-out phase to begin with, and keep a watching brief over who wins, because one of the issues we've had with megacap doing so well is how well positioned these companies look for AI. Yeah. That may not be the case forever. Yeah. In 3 or 4 years' time, there will be people coming after Microsoft with a better product for work productivity. Now, they may or may not succeed, but there will definitely be a challenge. The user interface point is really important. I'm glad you picked up on that, because if you look at the history of computing, these user interface changes have been very, very significant in terms of adoption. And if we go back to the PC, which is sort of existed in current form from the 1980 or so, it's not until the Windows 3 graphical user interface in 1990 that we really see inflection pick up. And suddenly this tool, because you don't just have to write a funny language to make it do things, you can point and click things and actually see what's happening. Yeah. Same thing happened with the mobile phone. The smartphone existed before the iPhone. There were 300 and something million units. The iPhone comes along, we now have a touch interface that's much easier to use. Obviously the costs coming down and the amount of things you can do with it is going up. But we get over the next 10 years, we go from 300 million to 2.3 billion users. Very, very big increase when you get this sort of change in user interface. So what interface have we got now? Well, it's natural language. It's how we speak, yeah, and how we talk and how we write. And we no longer have to talk to computers and computing in their funny language and code it up in a way that makes sense within a certain syntax and infrastructure. We can just write, I would like you to do this. And we've seen this already in companies we invest in, particularly on the software side, where finding out, for example, which of my customers bought things last month that haven't bought things this month, that's actually quite difficult. Even if you have all the data and you have all your data estate in order, it's quite hard to write that query. You need someone who's got specialized skills. There are already tools coming out, particularly some of the companies you invest in, where any business, not even business analyst, any marketing user, for example, or researcher could say, please show me who I should send my email targeting to. You see tools at Meta and Google already doing this. Not just, please buy for me these ads, but please find me customers who will buy some more of my stuff. And they will create the campaign for you, target the ads, create the copy. Yeah. It's quite amazing, yeah, actually.
No. You've got a sort of interesting insight into AI. Is one of the reasons why we sort of focused on it, because you actually have a dedicated fund at Polar, which has been sort of focused on AI. Would love to understand, the insight that has given you in terms of investing in the tech sector.
I think it's been really important. We launched the fund 6 years ago. So as I say, we've been excited about this space for a while. We've had OpenAI data in presentations for several years now. And the thesis of that fund was really, we could see this technology coming down the line. To be candid, we didn't expect it to get as far as it has done this quickly. Yeah. But our view was that the trust is a growth product. So we invest in companies that grow, and that maybe some of the most profound implications of AI, if it is a general purpose technology, as we believe it is, in the form of the same way that steel was, or that electricity was, or the internet was, if it is what we think it is, a lot of the money will be made outside of tech. And some of those areas will be things that we don't invest in because they're not tech, or we don't invest in because they're too low growth, or they have a profile that wouldn't be right for our trust. Yeah. So we launched this product to try and go after those. And this would be companies like RELX in the UK, for example, which has been a kind of key holding since launch. If they are going from selling a legal body of knowledge, which is still a good business, just not one that's that interesting to a tech investor, if they are now selling a AI-powered decision-making tool, which they've launched quite recently, that suddenly looks much more interesting. And we want a way to capture that. And so, very, very interesting in the early years, Yusong, who leads on that product, would be at NVIDIA's Investor Day or attending NVIDIA's Investor Day and would be looking at who the customers were and saying, well, who's buying all these GPUs, which corporates? And RELX was one of those. That's actually how that position came about. And we think that some of those companies won't become low growth to high growth overnight, but you'll see it in better margins, better efficiency, competitive differentiation. And that's been really interesting.
I'd love to hear your pitch, given how well large cap tech has done, as to what case you would make for running an actively managed technology fund versus just investing in an index of, the Magnificent Seven or the largest tech names.
Well, it's a tough moment actually to make that case from the numbers, because the FANGs have been, or the FANGs, mega cap tech, should we say, has been so good. And we've talked some of the reasons why that is the case. These are natural monopolies, and they have put up the growth and they have put up the cash flows. So, and the valuations are not ridiculous. They, maybe a little bit stretched, but they're not, certainly not 2000. Tech trades at 1.4 times the market, not 2.2 times like it did in 2000. So, the best companies, the biggest companies in the market are very, very good, and that has been why, if you are structurally underweight them, as we and most active managers are, it's been tough. Now we're top quartile year to date and over 3, 5, and 10, or certainly first or second quartile, and we're behind the benchmark. And that tells you, I think, that this pain is being widely felt, that when a cap-weighted benchmark, particularly a top-heavy one, the top 5 stocks in our index are 53% of the benchmark. When that's the case, and they're firing on most cylinders, things are very tough. So the case for active, particularly in the way we do it with a large team, with a very diversified product, is really to say that at the point that those companies stop leading, and just to be clear, we're not calling for that immediately. Small caps are at 20-year lows versus large caps in tech. Whereas we've burnt off everything that small caps have done. An index won't get you out of those names. Whereas we have got a very, very good selling discipline, and we have got a big team full of ideas, desperate to pull the trigger across the world, across the cap spectrum, in names that investors won't or will be unlikely to find themselves and unlikely to have the resources to research and meet and do the work on and meet the competitors themselves. And we think that is going to provide a really good opportunity for alpha. The second part of it is, if the shift from AI is as profound as we believe, you will need a large team of people all over everything. So the reason that we can move quickly to invest in Japanese sub-suppliers to AI server racks is because Jisong has been visiting Japan for the last 15 years, where we haven't had that much, but we've still been doing it. We've been doing the work. We know which companies are the good ones. We know which ones are the bad ones, which ones are positioned in a way for AI to win, as opposed to an index that will have a tiny bit of one company. So we think there's a lot of opportunity here, and we'll be delighted to take down those mega cap weightings and use that to fund sort of bigger positions in small and mid caps. So that's the opportunity set. We construct the portfolio around the benchmark, to be clear, because it has been so good, and thank goodness we have in some ways, with the idea being we want to offer our shareholders the best of what the benchmark has to offer, and avoid the rubbish, avoid the legacy stuff, avoid the incumbents. We think change in tech is non-linear, and make sure that we're not missing out on any of these exciting new ways to play a sort of super theme like AI.
I find a lot of people watch this show for education. They like to hear, how professional managers are thinking about investing in particular sectors or more generally. I always like to sort of, hear your thoughts in terms of if someone is investing in the tech sector or is interested in investing in the tech sector, are there things that you would either recommend that they read or watch? What are your thoughts on that?
Well, I have to plug our annual report, not least because since Ben and I and the team put a huge amount of effort into it, and our poor board have to read all through it, and we do put a lot of effort into that, and it does tell you what we think about the space and what we think about all the sectors, so I'd certainly recommend that. I'd also recommend, there are some great online resources from some of the VC funds. A16Z and Andreessen Horowitz has a brilliant resource where they go through all the different new sub verticals of technology and what's happening in interviews and podcasts and things. So that's been really good. And there's a couple of books that certainly have been important in our thinking. The Innovator's Dilemma by the late Clayton Christensen is a classic, but is still very good. I'm amazed by the number of people who are interested in tech investing and haven't read it, because it it is excellent, and it has aged. It's not all of it's perfect, but it's aged pretty well. And the other one is Geoffrey Moore's Crossing the Chasm, which is another classic about how diffusion works and how adoption cycles work, and that really informs our approach to make sure that we're in technologies that are being adopted. But yeah, it's a wonderful space to invest in, and I'd encourage people to learn more about it.
Alastair, it's been a fascinating run through the world of tech. I particularly enjoyed, learning more about the sort of your views on AI. Would love to have you back, at some point in 2024 as we can reflect on, how far that's come, and what remains in store for us.